Welcome to Tradespoon. My name is Vlad Karpel. I'm the founder and CEO of Tradespoon. And we were talking about two-legged strategies. We talked about if you have a bullish bias on the stock, what strategies execute. We actually talked about if you have a bearish bias, what strategies to execute. We were talking about selling credit call spreads. Now let's talk about the fourth strategy. So if you are bearish on the stock, you can execute a debit put spread. So let's take a look. How do you trade bearish put spread? So bearish put spread allows cost basis reduction. That is why we do them. It executed when general feeling toward an asset is negative, moderate downward moves. What are some of the characteristics? It's low risk, low reward, and it is a low requirement that allows you to participate in more expensive stocks. Trade gives up some upside potential in exchange for a chance to recover premium. High probability of success compared to long puts. Why? Kind of intuitively making sense because you sell that out of the money put and hence reducing your capital requirements, you're reducing your cost basis and increasing probability of success. So let's talk about setup. You sell out of the money put with that lower strike price. You buy in the money put option with the higher strike price. So it's a debit put spread. You have to pay to participate, to get into a debit put spread. You use the same underlying asset. You look at the expiration date, and based on the Tradespoon analytics, statistically speaking, 50 to 75 days till expiration is the most optimal time horizon for debit put spread. And you select strike prices based on probability of success. At Tradespoon, we provide you with different technology that helps you select strike prices. Take a look at the probability calculator. Take a look at the stock forecasting tool to find the most optimal strike prices to trade. Example, strike price selections, point A and point B. You're buying at point B, you're selling put at point A. We're talking about expiration months, 50 to 75 days. Your maximum gain occurs at point A. If stock drops below point A, that's your maximum gain. Your maximum loss in case stock goes up and you are wrong in the direction of the stop. If the stock moves beyond point B, if you look at the x-axis, if it moves to the right beyond point B, that's your maximum loss. Your break-even point occurs roughly between point A and B, depends how much debit you paid, and this is a directional trade. You have a negative outlook on the stock. Let's talk about return on capital. It's very important. Return on capital determines at what point you get into position and what point you get out of the position. With bear put spreads, you pay the cost of the long put at the money options and you earn proceeds. This is what allows you to reduce your cost basis by selling that short put, out of the money short put. Let's talk about capital requirements. This is the original debit you paid for the spread. Now let's talk about calculation for maximum gain. Maximum gain is the difference between the strike prices of point A and B minus the original debit that you paid when you got into a position. How do you calculate maximum loss? Well, that's original debit that you paid. You can never lose more than the original debit you paid for the debit put spread. And break-even point, again, depends how much premium you pay for that spread. It's somewhere between the strike prices. If you want to find out more information about us, please visit Tradespoon.com. We have great webinars every week where we have guest speakers. And you can also open up a free trial where you can get exposure to our technology and also our daily trade recommendations. Please follow us on social media. Thank you very much. And be sure to look at all the videos we have about how to trade options, technical analysis, and some of the other very important topics. Thank you.